There's a big OPEC meeting coming up next week. They're going to discuss another 400,000 barrel per day increase. You've probably seen the headlines flying around, but let's get into it this week. Let's talk about where we're at, what that might mean for the market. We've got a short week and a lot to talk about, so let's get into it this week in oil. Hey, I'm Aaron from the Oil Balance, and I'm here to elevate your understanding of the oil markets. All right, so let's get into the chart pack here this week. And remember, if you go to our website and you subscribe to the Elevate Your Understanding subscription, I can send you an even bigger chart pack than this and goes over a lot more details. So check that out first. Anyway, let's get into the chart pack here this week. Starting off with WTI prices. So we're still sort of stuck at the high end of this range on a weekly chart that we defined a couple weeks ago. Again, a breakout's possible, but then you've got this other resistance level right here that we could hit up against pretty good. Still thinking support is down around the recent lows, around that $55 range. And as I've said a couple times before, the $60 price that we're currently at right now is sort of tough for US producers in that it's kind of a yellow light, as we've discussed here recently. It's not really telling them to ramp up production. It's not really telling them to really slow down production. Just maybe take their foot off the gas a little bit, as the CEO of Diamondback mentioned. So we're sort of stuck in this range, waiting to see what OPEC will do. And then I'm sure after that, things will progress. We'll start to maybe move into a different range. In terms of the domestic demand front, I'm just trying to set the scene for you here and what's going on going into this OPEC meeting so you have some context into sort of what we're seeing. Last couple of weeks, we've seen relatively low, at least compared to last year, domestic gasoline numbers. The distillate number this past week was pretty bad, but again, don't put too much stock in just 1 week's worth of numbers. Jet demand is still looking pretty good at the top end of the 5-year range. But you take all this together as sort of a domestic transportation fuel. So we're leaving out propane for now. But if you take into account gasoline, jet, and distillate or diesel fuel together, the total demand is sort of ticking lower for transportation fuels when this time last year we were going higher. Of course, this most recent data point we've got is sort of the week before going into Memorial Weekend. We probably should see a big transfer of gasoline and diesel and jet fuel out of primary storage, which is what the EIA measures, going into tertiary storage, so going into sort of retail locations and that sort of thing. So we very well might see a big increase in demand as the market sort of tries to get ready for Memorial Day weekend, if that makes sense, moving supplies from the big tank farms that you see and moves it out to more retail levels where it's more accessible to the average consumer. So yes, I'm a little bit troubled by these numbers right now. We should get a good number on the next report. In terms of margins and values, things are still looking okay. I found something really interesting is the RVO has really popped up here these last couple of weeks. If you don't know what that is, that relates to RINs and renewable fuels, that the refiner or the blender has to sort of ensure that they blend enough renewable fuels into the market. And there's this credit program going through called RINs, which I could do a whole different video about. If you're interested in something like that, let me know in the comments, and I can definitely drop a video just about this one subject because there is a lot to it. The point is that the value of these RINs are sort of already embedded, if you will, in the gasoline and in the diesel futures markets that we see. So we need to strip those out to be able to look at things in a more similar context. So as you can see right now, we are well above $6 per barrel on the RVO, whereas this time last year we were closer to $4 per barrel. So, that's $2 of just at least the transportation fuel that you have to take back out. So that's what I've done here on this RIN adjusted Gulf Coast 321. So again, this is looking primarily at gasoline and diesel fuel as sort of a synthetic margin of what the refiners might be getting. And we've been really flat. So even though you've got this increase in the RINs, the RIN adjusted numbers have been really flat here. and sort of similar to a year ago. So again, this chart here on the rent adjusted chart is more apples to apples versus previous years. So again, things are going okay for the refiners. We're kind of hitting up against year ago levels and roughly in the middle of the 5-year range. 2022, with the Russian invasion of Ukraine, really set prices high for refiners, and that probably won't be repeatable anytime soon anyway. I've also given you this little table this week, or this little chart this week, putting everything in a dollar per barrel value, all the big big cuts or oil markets that we could talk about or do talk about on this channel, just so you get an idea in terms of what's the most valuable. So for right now, RBOB or gasoline futures is the most valuable. And again, these have the RINs in them. These are just the straight prices getting off coming off of the CME. At any rate, so gasoline and diesel fuel are the most valuable. Ethane here is the least valuable in terms of dollars per barrel. But again, just sort of gives you an idea, some sort of reference in your head if you're sort of new to these markets, of where the value in things are. So moving on, NYMEX related inventories. Remember that all the big NYMEX oil contracts are all physically delivered, so it really pays to watch what's going on in those delivery locations. So for crude oil, things are still very tight. We're still very low in terms of Cushing crude oil stocks. In New York Harbor, diesel stocks were still near the bottom of the 5-year range, or a little bit above it, definitely below year-ago level. For gasoline, for RBOB futures in New York Harbor, we're right at sort of year-ago type levels. And then propane at Mount Belvieu, we finally did get a big uptick this week in inventories. We're below year-ago levels, but again, the transition from draws to build kind of got drawn out a little bit further than it did last year. So yeah, I'm a little bit worried about this, but it should start to catch up here pretty quick. In terms of the shipping demand with the tariffs and everything, we were pretty worried about what was going to happen with diesel demand, especially on the West Coast. Things seem to be sort of chugging along fairly nicely now. We did get a big increase. If you look at this week 22, sorry, this top bar here is the data from the previous week, and this lower bar is the most recent data that we have. So this week 22, the old number was just under 60,000 TEU. This week it's moved up to 65,000, so that's a good increase. And again, for the month of May, it looks like we're up to about 414,000 TEU versus year ago we were at 463. So yes, year on year, there is a difference, but it's not as bad as maybe I thought anyway going into this tariff situation. So that's probably good. We're seeing diesel prices in California, LA Carb diesel spot prices, so these are wholesale, down a little bit week on week, still below year ago type levels. Keeping a close eye on this, but it still seems to be sort of within a comfortable range, so I'm not too worried about demand. I was thinking, again, if demand really fell off a cliff, we would see it with these wholesale prices pretty quickly. Gasoline spot prices are down a little bit week on week too, sort of following what we did last year. So that being said, you would think that retail prices would have gone down. No, that's not the case. There's only one region here in the Rocky Mountains, Pad 4, we actually see retail gasoline prices going down week on week. Every place else was up. So again, that's a little bit interesting. We are going into Memorial Weekend, so maybe that has something to do with it. But if you saw prices go up at the pump and you thought, wait a minute, that's not right. Well, at least at least the data proves out that you did see prices go up week on week. So that's a bit interesting there. So now let's pivot to what OPEC is looking at. Again, as I've mentioned, there are several different sources to look at for OPEC information. Of course, OPEC themselves put out a pretty nice monthly oil report. If you go to their website, you can get that. But it's very much coming from the lens of OPEC. They have their own research teams and everything, but it seems to be very much coming from OPEC's view of the world, which isn't a bad thing. You just need to know that's what's sort of going on. There's another group that I really like to use called Petrologistics. Again, they're not a sponsor of the channel or anything, but I just, over the years of doing this, found their information to be the most useful and sort of make the most sense in terms of what's actually going on in the market. So go check them out, Petrologistics. At any rate, if we take the most recent data from Petrologistics, which would be the May preliminary data, versus the June target, it has sort of the 8, which are participating in that sort of extra cut, all pretty much overproducing. The only one who's not is Saudi Arabia. Everyone, to some extent, is overproducing. Kazakhstan and Iraq being sort of the big ones. Oman is pretty big as well here too. I changed these to percentage-wise. I'm thinking in my head in terms of volume, where I think Iraq in terms of volume would actually be the worst offender, just in a barrel per day sort of thing. But converted this to a percentage to kind of keep the Petrologistics data set hidden a little bit. So I want you to see the information. I don't want to give away their data though. If you look at the green bars here, this is the actual numbers coming from OPEC, and it's their secondary sources. So it's not the direct reporting of the countries, but the reporting that the countries want OPEC to use, if that makes sense. And so there's a little bit of a time difference here. Petrologistics are looking at sort of what we know so far in May, whereas the OPEC numbers are from April. Both are set against the June target. So both would tell you, well, I'm sorry, the OPEC numbers would tell you there's plenty of room to sort of grow into another increase if they wanted to. There's been, most everyone's compliant. If you look just at the OPEC numbers, at least April versus that June target, Kazakhstan being the one sort of standout here that's sort of already gone above and beyond what they should have done. So again, if, as I mentioned, you look at these numbers and you realize that OPEC is submitting numbers to OPEC members are submitting numbers to OPEC in general, that they sort of want them to share and to understand. You would think, well, there's nothing too bad going on here. Everyone seems to be in compliance except for Kazakhstan. There's been plenty of headlines and ink spilt on that issue lately, where they've got production increases that were scheduled for years ago now coming online. So let's set that aside for a minute, the Kazakhstan issue, and just look at the difference between the two sort of reporting agencies. So I think it makes more sense. The headlines, the rhetoric we're seeing out of Saudi Arabia, I think the Petrologistics type numbers make more sense or maybe closer to reality than what the OPEC numbers from April were saying. In other words, Saudis are getting pretty frustrated with everyone else being able to increase production above and beyond their targets. And of course, we've had, public reports right on the OPEC website. You can see where they're going back and they're saying, well, certain countries you need to scale back, you need to reduce production to get to where you're supposed to be in terms of the various agreements. So again, the green numbers don't make a ton of sense to me in that, from that perspective. The blue numbers, I think, make a little bit more sense, and why it's becoming such a big deal, why they might just go ahead and rubber stamp a 400,000 barrel per day increase, because it helps legitimize this overproducing that's going on. So the other thing you have to really worry about, especially if you're Saudi Arabia, is for everything just to sort of fall apart, this agreement just to fall apart, and everyone start producing at whatever levels they want. So if we can look at this, so in terms of, obviously production has come down, and that's true, sort of depending, you can look at all the various sources and they all point in the same direction, that yes, OPEC production has gone down. The question is by how much and relative to what and that sort of thing. But by all measures, yes, OPEC production has gone down since 2022. The difference now is, sort of where is it going? How are they controlling exports, that sort of thing. So if you look at it in terms of exports divided by production, so in other words, you would think if you're a oil producing nation, that you produce the oil that you need, and anything that's surplus, you sort of export, and that's where you make your money. Whereas, the things that you need for your own country, for your own economy to keep running, you sort of keep those in house. And yes, that's true to a large extent, but we can see here that Saudi Arabia is, of course, increasing that internal demand. So there's a couple interesting things. We've had some refinery expansion projects going on in Saudi, uh, just by themselves. They do use crude oil in the summertime as a means to create electricity, just to burn the crude oil to create electricity. So the hotter the summer, the bigger that demand gets, and that will fluctuate sort of year on year. But you can see from this chart, hopefully, there's been a little bit of diversification going on in terms of them expanding their own sort of internal demand while at the same time reducing exports, again, to try to keep the market somewhat balanced, which is what OPEC's goal is to keep the market somewhat balanced so that everyone can sort of sell their oil that they need to and that sort of thing, and make an income without one country going out there and completely crushing things. So that's sort of the issue that Saudi Arabia has. And that's why the Trump visit was so important a couple of weeks ago, for them to start making some trade deals outside of and create revenue outside of just the oil market. So this is nothing new. Saudi's been trying to do that for probably a decade now. I'm just saying that the most recent meeting between when Trump went to Saudi Arabia, again, that's in terms of the timing, in terms of these OPEC cuts and all this sort of thing, I think it was actually pretty important. And they did seem to get a lot of concessions in terms of trying to build different parts of their economy to pivot away from just being linked to an oil economy, if you will. So there's a lot of moving pieces, of course, going on with all these OPEC meetings and whatnot. But that's what we need to sort of keep in mind as we go into this next meeting. The other thing is there's a huge difference between the sets of numbers. I think most people, and I'm speaking in sort of generalities here, most traders and trade shops will probably look at the IEA balances first as like a sort of rule of thumb or an approximate starting place, or there's a little more trust, I guess, going on in the International Energy Agency numbers and in their forecast. And I know certainly in my career, that's one place you can start and then say, well, I don't agree with where they're coming up with this change or that change, and maybe start picking away at some of their individual forecasts. But anyway, it's maybe a place to start. OPEC does a similar thing where they put out their demand forecasts and their supply forecasts, and to sort of map out the future for you, which we also do here at the Oil Balance. We have a full subscription where all we're doing is looking at balances. It's much more US based, and we're looking more at the individual products. But it's the same sort of idea where you have a demand forecast, you have a supply forecast, and you figure out what that supply minus demand looks like and where that puts inventory at the end of the day. So that's what we're trying to compare here. And this makes a huge difference in how each group sort of views the market, if you will. So what I've done in terms of the OPEC supply, as I've gone ahead for the balance of the year, I've plugged in, like I said, it seems like consensus is, well, OPEC will increase production by another 400,000, or at least that's what their headlines will say. So I went ahead and put that in for the balance of the year. OPEC in their reports, they don't necessarily give you the forecast for supply for the rest of the year. You can kind of fill that in on your own, at least in terms of the OPEC component. This year, they made it really easy to do that because they already put out a schedule of what they think production will do separately in the report, where they were trying to bring back that extra production they had taken off the market. So that's what I've done here for 2025 and 2026 to fill in those sort of missing pieces in the OPEC report itself. So what I've mentioned before is OPEC has demand set very high, and these numbers are the most recent data points we have for both groups, so you can sort of line them up side by side. So for 2025, OPEC sees global oil demand at 105 million barrels per day. The EIA sees it at 104. EIA has an increase of 840,000 barrels per day demand globally year on year, while OPEC has 1.3. So right off the bat, you can sort of see how, from an OPEC perspective, ramping up production makes sense. If we look at the supply side of things, OPEC has a much lower view on supply, even with the OPEC numbers already sort of baked in there. With only 100, if you want to round it up to 104 million barrels per day, up 1.47 million barrels per day versus the EIA's 104.6, which is up 1.6 million barrels per day. So the IEA is adding in those OPEC barrels as well, on top of just regular production from the rest of the world, including U.S. And then you can see the 2026 numbers there, following basically the same pattern, but for OPEC, things get a lot more balanced. In 2026, where your demand is 106 million barrels per day and your supply is 106 million barrels per day. And then you get to a much more balanced supply minus demand sort of number, a much smaller change. And of course, these are just annual averages, right? So you can still get fluctuation in there depending on what refining does for maintenance and peak demand season and that sort of thing. But overall, this would mean a fairly balanced market at only 220,000 barrel per day of undersupply, if you will, because your demand is slightly bigger than your supply. But for 2025, for the balance of the year, and we've already got pretty solid data through March anyway, so you're only really looking at the 3 quarters left in the year. They still have a undersupply situation, the way they're looking at it, of 1.2 million barrels per day. So that's a pretty big deal. And if demand were really this big, that's a very big deal. So another million barrel per day higher than what the IEA has in their stats. So hopefully this makes sense that there's sort of two different ways of looking at things. This is the way OPEC is looking at it, meaning that there's probably room for another expansion. I think most of the rest of the market's looking at it more like the IEA is looking at it. So if you sort of back up for 1 second and say, well, there's got to be some sort of third party or some other point we can plot against, you're right, there is. There's a couple of different agencies that report crude inventories. Kairos is a fantastic one. If you're in the market, I definitely suggest you checking them out. But these numbers are actually just from OPEC themselves. And we're just looking at OECD crude stocks because there's a very high correlation in crude oil price movements and these OECD stock levels. So again, that's another reason to go check out Kairos. At any rate, what it's showing is we've had a big increase so far this year in terms of crude stocks. So that would not necessarily lead you to believe that this OPEC number is correct, that we'd be drawing at an average rate of 1.17 million barrels per day. I mean, you would see inventories being depleted pretty quickly if that were the case. On the other hand, a build of 700,000 barrels per day that the International Energy Agency is looking for is even more aggressive than what we're seeing here. So I believe this increase from sort of Jan till March, you're looking closer to 32 million barrels per day. If you look at sort of this December to March number, it's 40 million, not barrels per day, but 40 million barrels globally. So that's a pretty good increase. And we have seen a couple years where it has increased in a similar fashion, and the market was sort of, okay, but was getting fairly heavy. So this is what we need to keep a close eye on, these sort of inventory levels and what's going on. So OECD would, of course, exclude China. That's sort of the big market that's not captured in the OECD data. It sounds like their stocks are increasing as well. Again, I had a chat with the guys at Kairos, and they were telling me that Chinese stocks are up actually pretty decent year on year on their inventories as well. So the data that we're getting about inventories globally would lean closer to something like what the IEA has. Again, it's a little bit apples and oranges because you do have a lot of refinery maintenance going on in the first quarter of the year, especially in the March timeframe. So we'll be looking very closely at these numbers here over the next couple of months to see what April and May do in terms of inventories. But just to sort of, again, there's that feeling that you got at least two different agencies reporting on what their expectations are, and inventories, at least in the first quarter of the year, seem to be pointing to a balance more like what the International Energy Agency has than what OPEC has, which is the big difference, which is why everyone's making such a fuss about what OPEC is doing. Because if OPEC are actually wrong about the demand being so high and they try to rush inventories back to market, or they try to rush crude production back to market, they could potentially crush this market. At the same time, what's going on is you have the Saudis who have taken 2 million barrels per day off the market voluntarily, and the schedule that they originally set out, before they came up with the 400,000 barrel per day increases, that original schedule had them bringing back 1 million barrels per day by September of 2026. So that would get them back. That original schedule would have them back at 10 million barrels per day of production. And if you think about that, multiplying that through by the value of crude, assuming hopefully for the Saudi it's in that $60 to $70 range, that's a lot of revenue, right? That they could potentially capture. That's what the plan is, for them to capture that revenue as it comes back to market. So that's the tough spot that Saudi's in. And again, it comes down to whose numbers is correct, at least directionally correct. Are we going to be net building in 2025? Or are we going to be net drawing in 2025? So that's sort of the video I wanted to give you today. There should be a lot of headlines going around this week, probably, but I want to let you know where we are, sort of where our starting point is, to better help you figure out what's going on. So again, my personal take is we'll probably get that 400,000 barrel per day increase, 411,000 barrel per day increase in that meeting next week, but it's more to probably legitimize some of the cheating, which means you'll probably still see comments about how so-and-so country has to sort of rein in their production a little bit, probably looking at Kazakhstan again to sort of rein in their production. Will the markets take a big hit from this? I don't think so just yet. So as we discussed before, from a timing perspective, if you're going to bring production back to the market, the absolute right time to do it is in the summertime when refining demand is at its peak. So maybe they can get away with this for a couple months of telling the market they're bringing production back, when in reality they're trying to get some of these other countries like Iraq and Kazakhstan to maybe pull in the reins a little bit on their production numbers. So it should be interesting. I'm still thinking if we get a sell-off on the headline, assuming there's a headline that says, yes, they're going to increase 411,000 barrels per day, that's probably a buy the dip sort of headline. Again, I think it's already baked into the market to an extent, but it really depends on everything that they say. So there's, you can look at it just as that one headline, but there should be a lot of context going on in how they come to that decision and what they're going to do. So hope this makes sense. Hope this gets you up to speed over this long weekend here. Trying to remember everything that's going on. It sets you up really well for this week ahead. Remember, like and subscribe to this video, and go to our website, theoilbalance.com, to get more information. Thank you. Bye.